This video is going to talk about crowding out. Crowding out is one of the possible limitations of fiscal policy. And so this is a chapter from, this is a topic from chapter 16 in the textbook. So chapter 15 talked about how fiscal policy can increase aggregate demand. And so potentially how fiscal policy could be used to stimulate the economy. Expansionary fiscal policy meant you had to run a bigger deficit. So as we talked about in that video, one thing you could do is say increase the government spending, and at the same time you don't raise taxes. You got to run a bigger budget deficit, but that's going to have consequences in the economy as well. So we said run a bigger budget deficit because if you increase taxes, that could reduce households' income, and that could reduce C. So if you try to increase G, and at the same time you reduce C through higher taxes, you may not shift aggregate demand to the right. So suppose we try to borrow. Okay, if we're going to borrow, well, that money has to be borrowed from somewhere. And to see the effects of this, we have to look at the market for loanable funds. This diagram was first introduced in chapter 9. And I have it drawn up here, and remember on this market, the quantity on the x-axis is dollars, and it ends up being savings and investment. Savings and investment are the two sides of the same exchange in the economy. And then the interest rate is the price in this market. So we have demand and supply for money, for loans, really, essentially. The demand for loans, and that comes from businesses, and then we have a supply of funds that comes from savings in the economy. So I've got this market drawn out here, and it's in equilibrium. And importantly, let's look at it here, that the quantity of savings and investment is 500. Now, investment, remember, is here. That's the I, because this would be business investment. So this shows up, this quantity here shows up in aggregate demand as the I. So the government needs to increase government spending, and they're not going to raise taxes, so they have to borrow. That means they're going to have to come here to the market for loanable funds and increase the amount of their borrowing. So we're running a bigger budget deficit, and let's just say that deficit is going to be 200. So we're starting from a savings of 500. So what that's going to mean is there's greater demand for borrowing now. The government is going to come in here as a participant in the market for loanable funds and want to borrow more. They're a borrower. That's going to increase the demand for loanable funds. That's going to shift this demand curve to the right, and it's going to shift it to the right by 200. So I'll just draw this in here. And so with the additional borrowing, here's the demand curve for the government. Here's the demand curve for loanable funds, reflecting government borrowing. We'll have a new equilibrium. This is, in what we've been talking about in any market with supply and demand, going back to chapter 3, increase in demand, we have an increase in price and increase in quantity. So we'll have a new equilibrium here, and I'm just going to make up a number here, but we know that this shifted to the right by 200. So I'm going to say the quantity here, the equilibrium quantity increases by half of that. We'll call that 600. And then we'll come over here and say that the interest rate rises. It's got to rise to something higher, so I'll just pick 6 here as our number. So the government comes into the market for loanable funds. They have to finance their budget deficit that they're getting because they're trying to stimulate aggregate demand, shifting the demand curve for loanable funds to the right. And what we see here is that the amount of savings and investment goes from 500 to 600. What does that mean? Well, first off, the amount of savings in the economy went from 500 to 600 to be able to accommodate government spending. So and they did that because the interest rate rose. Remember, this higher interest rate is a reward for savings. So as the interest rate rises, we have an increase in the quantity of savings supply. We move up the supply curve for savings, and people decide to save an extra $100 billion here. So savings goes from 500 to 600. But then we also have to think about, well, what happens to overall investment? We know in total, the total amount of borrowing that occurs in the economy is 600, but the amount of borrowing done by businesses, to see what that would be in equilibrium, well, we've got the price here, and at a price and an interest, remember, for businesses who are borrowing, the interest rate is a cost. The higher the price, the less borrowing they want to do. The interest rate has risen from 5% to 6%. That increase in the interest rate is going to move us on the businesses on their demand for investment curve up to this point here. And at that point, we'll just say, let's say that that's 400. So the difference between 600 and 400, well, that's the 200 that the government had to borrow. So how does the government go about borrowing $200 billion for their budget deficit? Well, people save some more money, and that raises the amount of savings from 500 to 600. And the amount of money that businesses borrow falls from 500 to 400. That gives the government the 200 here that they needed to borrow to fund their deficit. So the government's gone into the credit market, borrowed the $200 billion they need to finance this increase in government spending without any tax increase. But what's happened? Well, the amount of the investment by businesses fell from 500 to 400. Right, those numbers are just made up, but the important thing is that the amount of investment by business falls from 500 to 400. That's the I component of aggregate demand, C plus I plus G. Remember, there's also NX in there, but we're just focusing on these components that are going to be affected by fiscal policy. So we have an increase in government spending that's driving the budget deficit, but we see that business investment, because of the higher interest rate, will fall. That's what we call that's the crowding out element of this. When the government goes in and borrows, and to some extent, when the government borrows more, to some extent, they're displacing business investment from the economy. This reduction that we've seen here in numerical terms, they have it here from 500 to 400, is a reduction in the I component of aggregate demand. That's going to offset partially the increase in the G component. But there's one more thing here. Savings goes from 500 to 600. Households supply savings to the market. Households will be saving more. They're taking their households will take their income, and they're either going to spend it, that's consumption, or they save it. When households save more, since they're saving more, their consumption has to have gone down. So the consumption could also fall here because of increased savings. And so we have two potential offsets to the government budget deficit. The government borrows to increase G with the hope of shifting aggregate demand to the right. But the borrowing crowds out some private business investment, and that's a component of AD, and that sort of offsets some of the effect that you get from this increase in G. And then if you have increased supply and increased quantity of savings in the economy, and that's coming from households, that's going to reduce their consumption spending. So we have two potential offsets. So the increase in G with no increase in taxes is trying to shift aggregate demand to the right. But we've got two things going on simultaneously that would tend to shift the aggregate demand curve to the left, or reduce, the better way to think about it is that it's reducing the amount that aggregate demand can shift to the right. And so that's what we mean by fiscal policy might not be as effective as we think it would be, because the increase in G, even if we don't offset it by raising taxes, could be offset by reduced investment, and then also reduced consumption because people are saving more money. Now, this doesn't necessarily work out exactly like this, especially since there could be borrowing, since some of the supply of savings could be coming from outside of the country. So there's some additional things that might mean that these reductions may not exactly cancel off the increase in government spending, but this is what we mean by crowding out, and why it could mean that government expansionary fiscal policy would be less effective than we initially first thought in Chapter 15. Crowding out is also another thing to keep in mind when we think of like what's the cost to our economy of the government of the national debt, when the government borrowing, if the federal government having borrowed so much money. Well, one of the things that it will have done is that they will have crowded out some private investment. The government currently owes about $24 trillion, and that has to be borrowed from somebody, and that's savings that isn't available to go to, say, for instance, business. It isn't available to go to for housing loans, or for to let people purchase new appliances or cars. That's $24 trillion that in effect has come from somewhere else in the market for loanable funds. So the total amount of the government borrowing here in the aggregate will have at some level crowded out or displaced some private investment. Whether that's a good thing or not is beyond the scope of this video to get into. You'd have to try to address the question, well, what's the government done with that $24 trillion in debt that it's run up over the course of decades? And like what would businesses have done if they had that money to invest? And you'd have to try to say, whether the debt has, because of what the government spent money on, it has improved the economy more than it's hurt by reduced investment by businesses. But crowding out is also important as a concept to keep in mind in terms of thinking about what are the economic effects of a large national debt for the economy as well. So that's the crowding out from chapter 16.